In summary, the qualified business income deduction allows taxpayers to deduct up to 20% of their pass-through income, which is a good thing for taxes. However, we still have to observe three hurdles, which is that for high income earners, there's a wage and capital limit requirement. If you have losses in a prior year, there is a qualified business income loss carryover that we have to take into consideration, and taxable income also has to be taken into consideration. That being said, proper compensation planning solves the most common hurdle that trips people up, which is the first one. The Section 199A qualified business income deduction was created by the Tax Cuts and Jobs Act of 2017 and allows individual owners of a pass-through entity a deduction of up to 20% of their business income for federal tax purposes. This comes with a few caveats because higher income individuals have to analyze both their pass-through entity's attributes and their individual taxable income to calculate the deduction. And although it is not as common, individual taxpayers also have to observe if they have a qualified business income loss carryover or if they're hitting the final taxable income limit. As part of our compensation planning analysis, we take all of this into account. Before we can begin numerical analysis, we must first look to the business activity itself to determine if it's a specified service trader business or if it's a qualified business. An SSTB, specified service trader business, is one whose principal asset is the reputation or skill of one or more of its employees or owners. That includes services in the fields of health, law, accounting, actuarial sciences, performing arts, consulting, athletics, financial services, brokerage services, and the list goes on. This also includes a variety of investing activities, but generally does not include rental activities, real estate sales, or insurance sales. And anything that's not considered an SSTB is going to be called a qualified business. And like I said, that includes most rental activities, and almost every product-based business is going to be safe and called a qualified business. Okay, so the next step in planning for QBID is to analyze your individual taxable income, not including QBID itself, and to determine if you're below the threshold amount, above the phase-in amount, or somewhere in between. For tax year 2024, the threshold amount is going to be at $191,950, and the phase-in amount is going to be $241,950 for single filers. And then the amounts are twice that if you're married filing joint, with a threshold amount of $383,900 and a phase-in amount of $483,900. If your individual taxable income is below the threshold amount, you're good to go and have no entity level requirements to max out QBID. That being said, you'll still need to pass the final two requirements that I'll discuss at the end of the presentation. If your individual taxable income is above the threshold amount, you'll need to observe the wage and capital limit, which I'll describe on the next slide, in order to receive the maximum 20% QBID. Otherwise, QBID will be reduced. For SSTBs, that's your specified service trader business, you will simultaneously be subject to the wage and capital limit and begin to phase yourself completely out of QBID. So that by the time your individual taxable income reaches the phase-in amount, you have phased yourself out of QBID entirely. Do not dismay. We may still be able to get your individual taxable income below the phase-in amount by doing other tax planning strategies. It's just that during this analysis, you do not qualify. For qualified businesses, the threshold amount means your QBID will be limited if you don't fall inside of the wage and capital limit. And by the time you reach the phase-in amount, you will have phased yourself completely out of QBID if you don't have any wages paid or any capital assets placed in service. So again, if you're above the threshold amount, your QBID is capped out at the wage and capital limit. Wage and capital limit is the greater of 50% of all the W-2s the entity has paid to its employees, including yours, or 25% of the W-2s paid plus 2.5% of UBIA. UBIA stands for unadjusted basis immediately after acquisition, and what it means is the original cost basis of an asset before any depreciation has been taken. You use the UBIA of an asset for the greater of 10 years or its maker's life. And maker's is modified accelerated cost recovery system, which just means the IRS tax depreciation schedule. If your qubit is limited by wage and capital limit, the easiest way to increase it is through proper compensation planning. Here's an example of how proper compensation planning can help a taxpayer reduce their taxable income by increasing their qualified business income deduction. On screen, you'll find a company that's made $1.5 million in revenue and has expenses, including officers' compensation, that brings their net ordinary business income down to $1,050,000 before compensation planning. With $1,050,000 of net operating business income, you would expect a potential qubit of 20% or $210,000. Now, because their wages, the W-2s paid to all employees, including officers, only adds up to $300,000, their wage and capital limit is 50% of that, or $150,000. And because of that, their actual qubit is only $150,000 instead of the $210,000 potential. So in order to correct for this, what we can do is we can actually increase their officers' compensation to $235,714. And what that would do is bring their net operating business income down to $964,286 with a potential qubit of $192,857 is less than the potential qubit previously. However, the actual qubit they're taking is $192,857, meaning they're maxing out the qualified business income deduction through proper compensation planning, and that results in an additional deduction of $42,857. And for somebody who's in the 37% tax bracket, that can mean an estimated tax savings of $15,857. Note, depending on your facts and circumstances, you might actually need to lower your W-2 in order to result in a higher qualified business income deduction, or the capital limit might also be taken into consideration. Like in the case of real estate businesses, you don't really have a lot of wages, and so usually you're using the other wage and capital limit, which is the 25% of W-2s plus 2.5% of UBIA. So we do the entire analysis during tax. Your final two considerations are going to be what I'm going to call a QBI loss carryover. And so basically what that means is if you had pass-through entities with losses in prior years, we actually have to use those carryover losses in our analysis for the current year because it's just set in motion in order for people not to kind of game the system with timing of income and losses. And so basically those losses have to get used. The second consideration is going to be that your qualified business income deduction is also limited to 20% of your taxable income before qualified business income deduction. And basically what that does is makes it so that you can't push your income below zero using qubit. It's just a safety measure put into the code. These final two considerations aren't that common for most taxpayers. Like in the case of QBI loss carryover, if your business is profitable every year, that's a non-factor for you. And then the second one is only really becomes a factor when there's a lot of advanced tax planning going on and we're really driving your taxable income down. Now the qubit analysis is just one component of proper compensation planning. You still must observe the other four. So reasonable compensation must still be acknowledged. We must also take into consideration the self-employed health insurance deductions, and we also have to take into consideration retirement planning before choosing what the W-2 needs to be. And qubit's one factor in that formula. In summary, the qualified business income deduction allows taxpayers to deduct up to 20% of their pass-through income, which is a good thing for taxes. However, we still have to observe three hurdles, which is that for high income earners, there's a wage and capital limit requirement. If you have losses in a prior year, there is a qualified business income loss carryover that we have to take into consideration, and taxable income also has to be taken into consideration. That being said, proper compensation planning solves the most common hurdle that trips people up, which is the first one. This presentation was created to support our comprehensive tax planning service, where we curate strategies to assist taxpayers in reducing their tax liability. We do this by analyzing their business, real estate, and individual activities and determining the optimal structure, optimal accounting method, available tax deductions, and available tax credits. Then we prepare a summary of estimated tax savings and effect on global cash flow to assist our clients in determining which strategies to pursue. Finally, we coordinate the action items needed to actually achieve these savings. If you're interested in learning more, please schedule a call with us. Current clients, please reach out to your partner or accountant, and all others can call our office to schedule an intro call.